Hello, everybody. What I want to do today is to walk you through how to use the Flywheel self-storage deal analyzer. It's the underwriting model you see on the right of the screen. And on the left here, I've got an actual deal that I pulled up on LoopNet. But really, what the takeaway for today or what this video is going to be is the methodology and the process by which you would use the Flywheel SSDA to underwrite a self-storage deal. A lot of the inputs may be fudged, whether it's the target rents, things like that. That's okay. I'm going to not use this time to show you how to gather the actual information for the self-storage deal. It's more around once you have the information, once you've done a little bit of digging, maybe you've talked to the broker, how you're going to take that information and use the SSDA to come up with a realistic model for both the operational aspect of the property as well as the financial and returns aspect of the property. So just to get our bearings, here on the right, again, is the SSDA. I've copied it, and basically it's bare form. Some values may be different, some things may be different here or there based on what version you're pulling from. But in general, this should look pretty familiar. A couple things about the SSDA. First of all, it's meant to be much simpler than a lot of the other models you're going to find online. I really like to work within one view. I don't like to be switching tabs back and forth. So really, all the salient information, both inputs and outputs, are contained in this one particular view. You'll see some other tabs here at the bottom. Those are numbers that are kind of mostly just behind the scenes. Everything that's important is right here. Things that are in blue are, by kind of standard convention, those are inputs that you can edit and you're expected to kind of confirm and enter your own values. The blacks are labels or various outputs. So you should not find yourself editing any of the black fields, the black fonts here. That probably means you're kind of going outside the bounds or doing something that's not well supported by the model. All right. I think the other big thing to note about this model is that it really is all based around the P&L, right? So I have a 7-year P&L here in the middle, and all the inputs and outputs really feed into the P&L. It's my personal perspective that you really need to understand the P&L, and that the P&L is really the source of truth about the property. There are some models that are super high level and rely on estimates and back of the napkin expense ratios and things like that. And there are others that go super, super deep and do monthly P&Ls. That's either much too little for my purposes or in my use, or it is a whole lot more than is necessary to come up with it with an accurate model. So you may not agree with that. Totally understand if you don't, but that's really the philosophy behind this model, is simplicity and then also the importance of the P&Ls as the source of truth. So let's get started. I have a property here on LoopNet that I pulled up. It's in North Carolina, my home state, and it looked pretty standard by what you might find on the various public websites. If you're talking to a broker, you probably have the OM package and full financials. And again, I'll be entering a lot of numbers here, which we may not know exactly how I came up with them, but that's not the point. The point is how to use the model itself. So looking at this particular facility, not a lot of information here, but again, I'll make some assumptions. I've done some math. The first step is to get an accurate view of a unit count. I went on Google Street View and Google Earth and kind of did some estimating. And I know that there are pretty much 26 5x10s here. There's 67 10x10s, and there are 40 10x15s. That's 103 total units. So I entered the current count of each unit type here, and then I zeroed out any of the others that didn't have anything here. There's no parking spaces and other, sometimes there's an office or other types of units, none here. But right here up in this main area is where you kind of enter the unit type mix and the rents. Sometimes a facility will have some non-climate controlled and some climate controlled. So in that case, I would, enter all the non-climate controlled. I probably put a little label here, non-climate controlled, and then once I started in climate controlled, I put a little label here and then enter the dimensions and the rents and everything else. So if you have a mixed facility like that, that's how I'd handle it. But in general, these are the unit counts. So This facility I know has very cheap units. Again, it's kind of a rural small market, so that's not unexpected. Let's say that I got a package from the broker and I know that the current rents are around $35 for the 5x10s, 50 for the 10x10s, and about 100 for the 10x15s. Okay, so I would enter that here in current rents. By default, the model assumes that you're not raising rents and you're just going to keep the prices as is. Most of the stuff that I work on has a pretty heavy value add component and has been mismanaged in some way. And so there's quite a bit of room to push to market. So we want our target rents. That's what we want to put in here. So we're going to assume that we've done some research for our area and we kind of know what those target rents are. And so for the 5x10s, I'm going to say my target rent is 49. For the 10x10s, I'm going to say 89. For the 10x15s, I'm going to say 129. That's, for me, that's kind of what I see, and this is November 2022. That's a good target for what I would call a rural non-growth market. If you were in a city or some other places, you would expect those target rents to be much higher. But for this property, those are our assumptions. All right, so once you've done that, go over here, and you should see now that the total storage square foot here is calculated to be 14,000. We look over here on the summary, and it is in fact a 14,000 square net rentable square feet. So we know that's accurate. 133 total storage units. They don't tell us how many units there are or the type. Not very helpful of them, but that is what it is. Once we've entered that, current rents, target rents, all the unit types, the next thing that I like to do is go over here to the current P&L section. And we see that based on the current rents, the gross potential rent. So if there was a tenant in every single unit and every single unit was being charged market rents or the target rents, this is what this could be bringing in. And because we don't have any occupancy statistics, I just put that every single unit is occupied. So the physical vacancy is 0%. That was auto-calculated for me. The other vacancies is kind of our little fudge factor for looking at what we've underwritten current performance to be and what we have been told the current financial performance is. So this listing has told us that they're basically, they have an effective gross income of $79,000 a year. So potential minus vacancies comes to about $79,000. So here, this other vacancy field is meant to account for not necessarily physical vacancies, but all the other types of vacancies, loss to lease, all the things that are undermining the current performance of the property. And what we want to do is kind of use that as our fudge factor to bridge the gap between the gross potential top line here and what we know the current operating performance to be. So I entered about 20%, which for mismanaged or undermanaged properties is not unusual at all. And I got the net rental income to be about $79K, which matches pretty darn closely to our effective gross income. So these numbers match. I feel good about that. Great. Then the next thing I do is I go to the P&L. And there are obviously some bigger ticket items in here that I want to make sure are accurate. And then I'll walk through some of the other line items as well and kind of show you how I look at an existing property and kind of come up with some estimates. Taxes, they've told us the taxes are $3,350. We will take their word on it. And because I know this market, perhaps I know that it reassesses, in 2 years from now. So what I'll do is I think I've kind of underwritten automatically just a 15% increase on taxes year to year, or at least to projections. So I'll kind of leave that in as it is. It's already done an automatic 15%. And so what I'm doing, I'm entering current, but then at the same time, I'm also thinking about what does my stabilized performance look like? What is that? And that's what the projected column is. So that's where I hope to get to. And then I can do individual tweaks within the P&L itself. But I like to have these two side by side, and then it extrapolates out what an actual P&L might look like. Okay. So taxes entered current. Again, this financial statement here that they provided us is basically useless. So we're really left on our own here. Let's just say that I'm I know from my experience that 14,000 square feet, it's metal construction, kind of a rural market. Insurance shouldn't be too bad. 3,500 seems about right. I'll usually raise it for projected, just to assume that I might want better coverage, but I always put a little inflation factor there. Payroll personnel, a lot of these mom and pop ownerships, they are probably managing it themselves. So on their line item, they have 0 for payroll personnel. My model is remote management, so I will have somebody who's local that will come by, but they're hourly based and they're not there all of business hours. It's usually 5 hours a week. Call that $20 an hour pay rate. So it's 100 a week, 400 a month, 4,800. So about 5,400 for a small property like this per year is kind of what I would pay that contract labor. Management fees, again, current performance or current operator, they're certainly not using third-party management. If they were, you'd put it here, and nor are they charging for their time. So I've left that 0. My model is to account at least for about a 7% management fee. That's kind of around where third-party property management is. I do self-manage, but I want this line item accounted for, both because I want to be compensated for my time, but then also when I go to exit the property, the future buyer may also want to account for their time. So, even if I weren't accounting for my own time and had this at 0%, I wouldn't feel that great because I'm always thinking about what the exit looks like and how that potential buyer will be looking at the property. And so, this is a smaller property. It's in a rural area. You might get a smaller operator that is also looking at it the same way. For my comfort, though, I like to keep this at around 7%. Repairs and maintenance. Again, you don't know what actuals have been by this particular listing, but in general, there are some back of the napkins that you would use. I think I have here that my rule of thumb looks like it's about $25 per unit per year. So, we'll say current R&M around 2,400 to be operated at my standards. Maybe I'm going to be doing a little more proactive and preventative maintenance, so mine will be a little bit higher. Marketing. This property doesn't have a website. Can't imagine they're doing any sort of sophisticated marketing at all, so that's 0. I know for myself, I do want to do more marketing. 1 or 2 square foot referrals can be $100, $150 each themselves. So, at least a budget of $300 to $500 a month is what I will budget for. And you'll notice by default, my model inflates that in year 1 because my assumption is there's a lot of churn in year 1. You've pushed market rates up, right? So somebody who's been in that unit for 10 years is paying $19 a unit, and you're going to push their rent to $39. You will get some move outs, some more captive audience than you might expect, but you don't want to act like you can just push rents and there are no consequences. So because the expectation is that we will be sending out rent increase notices, assume there will be a little bit more churn, higher vacancies, and you'll see that the model kind of takes that into account, has higher vacancies before it normalizes out. And same for marketing costs. Higher vacancies, you're going to need more marketing to get people in. So I double the marketing cost in year 1 in the model, and then it normalizes to my projected expenses. If that is not what you expect from your the way that you are doing your modeling, then you can revert this back by editing the field here and just setting it to be equal to what the projected amount is. Utilities. Well, so looking at this property, if we look on Street View, it looks like we've got some lights. And let's see here. I mean, 1 or 2 lights. Oh, I see some of the back. Okay, so there's no water here. I don't even know if there's an office. But who knows if this is like a little office unit here. I don't know where there would be utilities, but for any property, you've got electricity, you may have dumpster, you may certainly have internet. If you're doing remote management, you want to have the gate wired up and everything. So utilities, I'll put, they're probably paying very, very little, 100 a month. I expect to pay what they're paying for electricity plus internet around 100 a month. I'll probably put it around 2,400 a month there. Landscaping is another big item, depending on the facility. This particular facility is mostly asphalt. That's good. It looks to be in decent shape too. I have Google Earth over here too. Looks like, you mow around the edge, keep the fence line cleaned up. So, you will want somebody to be out there on a somewhat regular basis, weeds popping up too. So we're going to assume $200 to $300 a month for landscaping. Again, I'm going to assume that the current operator probably is doing it themselves. You see that a lot. I'll put 0 for what they're paying. For myself, I probably at least want $200 a month. So between $2,400 and $3,600, we'll call it $3,000 per year. Software, again, current operation, none. I know from what I pay, so I use Easy Storage Solutions at the moment. I know what they're charging. It's probably about $150 a month right now for their subscription, which does include gate automation. So 150 times 12, 1,800. I should know that already. I'll put it at 1,800. I'm actually going to increase this to about 2,400 because there are residual things. I set up a Google, what's it called? Google Workspace, Google Professional Suite, whatever it's called, for each facility, for domain management, emails, things like that. And there are other shared costs here around software. So I will put that at 2,400. Payment processing, I keep it at 2.4%. That's what payment processing costs on ESS. Current buyer may not even be taking credit cards. Sorry, current seller may not be taking credit cards. I'll put that at 0. Contract services, these are things like pest control, other things like that. I suspect current owner not doing much. I think pest control might all we would need here. We'll keep that about 100 a month. G&A and miscellaneous, there's always just little things, that supplies and whatnot. So I'll leave that there. Legal and accounting, again, current operator not doing much there. If this were just a deal that I'm taking down myself, I'd probably put this at 1,200 total. That's paying for a bookkeeper and some end of year filings. This is something I'm raising money from investors. There's a little higher accounting requirement, so I'd keep that at 2,400. And then replacement reserves for when things go wrong. Again, this looks like it's $25 per unit per year that I have as my rule of thumb. I'm going to keep that there. So I have their current OpEx around 10K. Let's see. It looks like they said they were around 12K, so I'll add another 2K in here. Let's call it. Maybe they are in fact paying somebody to landscape. And you got some miscellaneous things here. Okay. So I'm looking at the current performance, and I just want to double check that it loosely aligns with what I've been told. Current performance isn't that important to me because I'm looking more at what the potential of the property is. However, if it's a stabilized property, you're going to want to feel really good about the current performance because your expectation is that will also be your performance. So 79K income, 66K NOI, 79K income on my model, about 66K NOI. Sounds good. Looks like I've aligned things here. I've also gone through and adjusted what I think my operating expenses are. Again, this is to my standard and with what my business model is, and I've updated these. So at this point, I just do a quick temperature check here. They don't have a list price. I just put $1 million as a starting point. So if this were $1 million, and if I thought I could come in here and push these rents as I've defined over this section, and with my operational overhead for $1 million purchase price, and let's actually use this time to talk about the purchase assumption. So again, blue fields means what you can enter and edit. Closing costs, I have around 2% of purchase price. It's a smaller closing. This is probably about right. If it's larger, if you're raising money from syndicators or from other investors, there might be more to your closing costs. So you can adjust that based on what you know. CapEx and reserves, great. I didn't talk about this. So anything that you might know you want to do and you want to fund up front are CapEx and reserves. And this field is pulled in over here from the amount over here. So over here, I've tried to kind of itemize the major items that at least I know I've had to do with my facilities when I purchase it. Some common items, you got your roofing, you've got surface, so gravel or asphalt, exterior issues, door repairs, gate security, so on and so forth. For this particular facility, paint looks a little tired, but again, for an area like this is, I don't think on day one we need to be worrying about anything. However, if you knew that maybe by year 3 you were going to have to repaint, you'd probably want to account for that in the CapEx, because you want to know upfront that you have the funding available for that. For now, though, I'm going to say no paint. Roofs look to be in good condition. I think they said it was built in 98. They did. So I'll go ahead and update here just to be sure. Okay. Surface is asphalt, looks like it's in good condition. A lot of times if it's gravel, it'll be pretty thin, and I like to go in and really lay a fresh layer of gravel, makes it look pretty sharp. Exterior, doesn't seem like there's much to be done there. Gate and security. So I did notice that there is a gate operator right here. I also noticed there does not look to be a keypad, right? Perhaps Google Street View is old. It's from December 2013, I see up here. It's quite old. I'd want to talk to the broker or the owner, whoever I'm in touch with, understand what the gate situation is. I'm going to assume it is what I see here. So I know I'm going to have to install a keypad and have it wired up. Looks again like we have a gate operator, so we don't need that. But keypad installation and some sort of controller that's going to interface between the software and the gate operator itself. I know from my experience that the installation of that is keypad plus controller is probably around $5,000. A little bit more if you have to do the keypad stand and foundation and maybe some wiring too. So I'll keep it around $5,000 for what I need to do on day one. And then I usually have an allowance for signage, right? Maybe I'm going to get the feather flags to put up to let people know it's new ownership. Probably put a big sign up on the gate for operating hours and website and phone number and things like that. I'm not doing any expansion construction contingencies. This is just a percentage of what I have for CapEx. And then reserves, I like to have 3 times my annual reserves on day one, just because stuff happens. We all know that. And I don't really want to be caught having to go back to investors or do anything like that. So that is where you would put your CapEx, and then that budget pops out right here to CapEx and reserves. These are costs you need to account for on acquisition. My acquisition fee is between 2 and 3%, depending on the size of the deal. Say you don't have one, you can put that at 0. Capital required basically is the sum of the down payment and closing costs and CapEx and reserves. Regarding down payment, that's over here in purchase financing. So this are your financing assumptions. Right now, I have an assumption of the purchase price, basically a 70% LTV. Okay. Once that field is there, now we know our down payment is $300K. Interest rate right now is around 6.5%. If you have an IO period, you could put it here. It's in months. Amortization, I'm going to assume only 20 years. Maybe you can get 30 from your bank. You could update that here. And so now we have good purchase assumptions in place. Okay. So for this deal, I would need to raise basically 340,000. Either raise it or I need to come to the table on closing day with 340,000, both for the down payment and for the liquidity up front that I need on close. Well, we don't really know yet if this is a good deal. So let's go down and kind of in the refinance and structure and fees and investment metrics sections. This is where we enter some more details and we start to see whether financially this is a good deal or not. So when I'm looking at the performance of a deal, I want to check really 3 high-level details. Again, this is my methodology. It's what the SSDA was built with that in mind. yours may differ, but I hope that the SSDA can still serve the purpose. The three high-level things I'm looking for are, can I refi on stabilization? So around year 3, what does my refinance look like? Am I going to be able to refinance? No questions. I'm not looking to get a huge amount of money back per se. If things are going well in the market, I would expect to be able to do a cash out refi. But if things have degraded slightly in those 3 years, I still want to know that I can refi, no questions. I won't get caught in that refi trap. I want to look at my return on cost to know if it is, if I have a margin of safety against what assets are going for compared to what I put into it. And I'm also looking at the cash flow or the DSCR throughout the life of the deal. So let's look at each of those items. So refinance, I'm going to assume, is at year 3. These are my assumptions of what the refinance is going to be. It's going to be using a direct cap valuation method. I'm going to assume that 3 years from now, maybe the market is even worse than it is today. Interest rates have risen a lot recently. So I'm going to assume that things are going to be valued at an 8 cap. And again, this is a tertiary market. It's a small market, so I can't expect to get a premium valuation. So I'm going to say 8 cap. I'm going to say it's going to be a 60% LTV, 7% interest rate, no IO, 20-year AM, et cetera, about 2.5% in transaction fees. I enter all that in for my refi. The first thing I'm checking is, am I going to be able to pay off my existing loan balance? And is there any capital returned? We see here, it's a negative return of capital, meaning I'd have to actually infuse money in on refinance to actually do the refi. That's not where I want to be. So that's my first clue that this deal may be tight at this particular purchase price. Let's go to the second bit. And by the way, this is the structure and fees. So, if you're just buying this outright, you could set it to be 100%. Then you are the manager GP, and then that's all you need to think about. But I'll leave it as is for now. Second thing I'm looking at is return on cost. 7.5% return on cost, which is your NOI on stabilization divided by your all-in cost. You want this to be well above the market cap rate. Okay, so I know for the current market that we're in, I personally am looking for a 9 or 9.5% return on cost. So at this purchase price, this property doesn't meet that particular requirement. Then I'm going to go over and look at my cash flow or my DSCR, right? I want to see well above 1.25, and in fact, probably 1.4 and above. And I see a little anomaly here, which is that in year 1, actually it's not an anomaly. In year 1, I'm more cash flow because it's during the IO period. I'm actually going to zero that out. I'm going to reset my initial financing assumptions to be no IO, 20-year AM. Okay. So I'm looking here and I'm noticing that year 1 actually has higher NOI than year 2 or 3, which is unusual. Usually year 1 is your lowest. And so I'm just going to go in and look at my assumptions. And I see that's because in my spreadsheet, because I'm saying it currently has 0 physical vacancy year 1, I just carry that assumption over in the SSDA template, but that's actually not accurate. I'm probably going to assume that there's definitely going to be some people vacating. Okay, so I'm just going to go up and kind of reset those. It has higher other vacancies in year 1, which is accurate because I do expect there to be more churn in year 1 before it levels out. My leveling assumptions are basically 16% total vacancies, which 16 to 20% may be accurate. Yeah, use your experience, but I'd say that's a good rule of thumb. All right, so now when I go back down, yeah, I see that the cash flow, the NOI slowly increases over time, year 1 being the lowest. That I think is accurate. Where did we adjusted management? Marketing. Yes, we did. I know we reset that, but I'm going to assume that year 1's going to have more churn. You're going to need a little more marketing expenses. All right, so looking at DSCR, starts off low, doesn't really get above 1.4 until you refinance. And again, at this refi, I'm actually having to put money back in. So this deal doesn't work on the DSCR front either. And then if I'm thinking about my investors, what investor is going to be excited by, a 1, 2, 3, 4% cash on cash return? None that I know of. All right, so that's how you take the operational model and look at then the financial elements. And at this point, you're playing that game of, okay, have I missed anything? What valuation does make sense? Are my assumptions too pessimistic? Are they too optimistic? So at this point, what I'll do is I'll just be like, well, what number starts to make sense? So let's say we got this for 750K. So I'm going to change the purchase price. Everything else stays the same. My capital required goes down quite a bit to about 250K. Looking at my return on cost, 10%. That's a healthy margin of safety for me, for what I know this market, this type of property. Looks like on refi, I could return, again, this is somewhat pessimistic or worse assumptions than the market I'm operating in today. But even in that scenario, I could return some capital. I should be able to refi no problem. Okay, let's go and look at our DSCR. 1.4 is and above. Even on refi, it resets back down. It's expected, but I'm still a pretty healthy margin there. Cash on cash returns. Okay, year one, to be in the positive, actually, for a lot of the work that I do, it's some pretty heavy lift. To even see a positive cash on cash in year one, it is actually a pretty positive sign for me. And it quickly gets to 6, 7, 8% plus through the life of it. That's pretty good. That's pretty good. So, I would play with this deal, talk to the broker, but in my head, I'm thinking, around 750 is where this makes sense for me. So that is a pretty high level overview. One thing you will not see in this model, at least as of yet, it'll depend on your feedback, is anything around the IRR. Okay, the IRR, I've done a lot of talks and a lot of blog posts about it, but the IRR is based on a lot of very forward-looking guesses, basically exit cap rate, interest rates, et cetera, et cetera. So I really don't do any modeling with some sort of exit price in mind. You can just get too cute tweaking that exit price, tweaking that exit cap rate to get to an IRR number that you want to see. It's just too easily manipulated of a number. So I don't even look at it in my underwriting. I know that if my refi looks good on worsening conditions, if my return on cost is well above market cap, and if my cash flow is healthy through the life of the deal, I know that I'll do well. If the market is amazing, my IRR is going to be amazing. If the market sours, my IRR will be depressed, but I still have enough returns here and a margin of safety that the deal is still whole, it's still solid. It's still a valuable asset to have in the portfolio at that point. So that's a little peek into the philosophy around why there's no IRR represented here. Again, at the moment, if people complain about it, then certainly I'm willing to hear them out. All right. So I hope that was a good overview of the SSDA, how to use it, the philosophy behind it, and the methodology. There are links below to some other write-ups about it. I'll try to continue doing other deals using the SSDA so you get a better sense of how to use it. And then if you have questions or you want me to underwrite some deals for you, I'm certainly available for that as well using the links below. So hope that was helpful. Thank you all very much for your time.